We get a lot of emails here at NetPicks, and this one comes from an options mastery student who had some really great questions. I'm sure these are a lot of questions that many traders have when starting with options. So here's a question that came in. How do you determine when to buy a call or put versus using a spread or collar or butterfly or iron condor? And what are the criteria you're looking for to make the decision? Now, it's been mentioned numerous times over the past that Mike over at NetPicks loves the flexibility that options offer. You're not limited to buying and selling calls and puts. You can actually trade different option strategies that allow you to adjust how aggressive that you want to be. So let's take a step further. You can also use different strategies to adjust whether you want to be bullish, bearish, or just neutral in the market. And you can't say that about any other market out there. If you're trading futures, Forex, or stocks, you're pretty much limited to buying or selling individual contracts, lots, or shares. Now, that's fine if you want to put on a directional bet, but we all know that the market does not always trend. In fact, more often than not, we're stuck in a sideways range. Now, trading options allows you to profit from these sideways moves instead of just getting whipped back and forth with false breakouts. Now, the flexibility that options offers, it's great, but it can be intimidating when starting out to know which strategy is best to use at the given time. Over the last 13 years, Mike at NetPicks, who teaches the options course, has taken thousands of trades, and he's tracked each and every one. As a result, he's come up with a method that fits his trading style and could also help you if you're looking for an edge in the markets. Now, let's walk through what his normal process looks like when setting up a trade. Here's the steps for identifying options trades. Number 1, have a small universe of stocks or ETFs that you look at on a regular basis. Now, Mike says it's time and time again in the training materials. Don't look at hundreds of names on a daily or weekly basis because in many cases, you're left trading names that you don't even know what they are. He'd rather focus on a small list of names that you get to know over time. This way, you can easily determine whether you're bullish, bearish, or neutral without spending a ton of time each day just staring at the charts. His watch list can change once a month, and right now his list is about 24 names. Those 24 names come from a universe of 50 stocks and ETFs that are tracked on a monthly basis. So in other words, when the watch list of 24 names is created for the month of October, for example, those names came from a universe of 50 products that have been tracked and researched for an extended stretch of time. Number 2, look at the charts for each product on your watch list to get a feel for any key levels, directional outlook, or even overbought, oversold extremes. Now, this step is really, really important in helping determine which strategy you're going to use. For example, recently there was an iron condor trade that was closed out on USO and that was open back in early September. Now, this trade was chosen because looking at the chart, you can see that we were at a bearish extreme. We're expecting either a bounce higher or sideways consolidation. The only way Mike really had to feel that the iron condor was a good strategy was because he's traded USO for the last few years. And this gave him a comfort level with the ETF that he would not have had if he just pulled it off a stock scan, for example. Now, looking at the charts will help you determine how aggressive you want to be. If you are strongly bullish or bearish, then you can reflect that in both your position size and the option strategy that you're going to use. If you're neutral, then you can also adjust your position size and go to option strategies that work well in sideways moves. Number 3, look at the levels of volatility, determine if it's high or low. Now, you can only do this if you track the implied volatility levels for each stock or ETF on your list. And this helps you know if those levels are high or low at any given time. So if the implied volatility is high, then you know that you have an opportunity to sell premium. If it's low, then you probably lean towards using strategies like long calls and puts and long vertical spreads. Now, the first choice for Mike is always to sell premiums because those strategies give you so many ways of being profitable. However, you've probably also seen over the years that when you wait for the implied volatility to be high, when selling premium, your odds of success really improve. Number 4, determine which option strategy best fits your outlook. You start by looking at the charts of each product on your watch list. This helps you decide if you want to be bullish, bearish, or neutral. This also helps determine how aggressive you want to be in your position size and your option strategy selection. So once you have an opinion on what you think the stock or the ETF is going to do, then you go to your playbook to follow the guidelines that you've outlined for each strategy. For example, if you're bullish on a stock and you want to sell a put spread, then you follow the short put spread criteria that's outlined in the Options Mastery Playbook. It's important to have criteria to follow for each strategy to make sure that you're always placing trades that give you a good odds of success. Now, these 4 steps listed, they are what Mike follows in his own trading every single day. And it's important to note that it's not a perfect science when you're selecting trades and adjusting your position size. There are times when you want to be conservative, so you might trade more spreads and use smaller position size and end up leaving profits on the table. But the whole goal here is to have a method in place that you can follow each and every day. You're not going to be perfect on every trade, but by following a method, you'll be sure to have trades on that you're comfortable with. And if this is the case and you're using proper risk management, then this will lead you to getting the number of trades on that will give you some better odds. You're not going to be backing yourself into a corner by putting on 2 to 3 trades and hoping for the best. By having a bigger sample set of trades, and the odds will play out better in the long run. Now, as in the case with any trading approach, the key is having a system that you can stay disciplined to. Swaying in the wind when everything you hear in the media these days or from other traders can lead to inconsistent results. Every trader is a little different, so make sure you're using a trading method that fits your style and your risk tolerance. Now, this may take time to develop your method, okay? But in the end, it'll make all the difference in the world. It's so important that if you don't have a system in place now, then take a big step back and don't put any more money to work until you have a system in place. You will see the benefits right away, not only in your P&L, but in your confidence as a trader. In the end, trading really is all about discipline. If you can become that disciplined trader with a detailed system in place, then you will be well on your way to success.